Right, stocks ended up with a really flat, kind of a really small range, low volume day today. Again, we have earnings coming up, or at least earnings season. We have options expiration coming up here. The options expiration of earnings season, which ends up being a pretty volatile period the next week. So a little bit of a calm before the storm, so to speak, with today's move. Some really important technical levels we need to be aware of that can dictate the type of move we might get over the next few weeks into the end of the year, one way or the other. So I'm going to break down those levels for you just to know, so you can kind of know what to expect, which way I'm leaning towards the kind of move we might be getting, and then what's driving the price action, especially today. It's a very similar pattern to what's been driving the price action for most of the year. So we're going to break that down to see why I lean in that one direction. We'll take a look at the different moves in the different sectors. We're going to start getting some unique moves there, depending upon these earnings announcements that come out, especially among the bigger name players. We're going to talk about a couple of bear markets that we've already been through, as well as a correction that hasn't even started yet that could be very telling for us. So that's an important element of our market expectations. Let's go ahead and get started. Today is Wednesday, October the 19th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, as well as the subscribe button down below the video. Hit the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things on the right, including all of our classes, upcoming classes here. Click this heart. Again, we almost got to 100. We're in that 85 to 90 range the last week or so after a really good streak there, being above 100 multiple days. So if you click on that, it opens up this tab. Hit that like button, and same thing here. This heart, this thumbs up. Click that. It opens up that. Click that like button. Again, the more you do that, it helps get our content out to all of our followers. Also, remember, these super thanks go a long way for us as well. We appreciate everyone who's been sending us those tips over the last so many videos. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we stayed above the 23% retracement level, the intermediate decline that we're on right now. So by that definition, we are still in retracement mode, even if we did come back down towards yesterday's lows and actually got a little bit of lower lows. Still have not filled in that gap, or even attempted to fill in even a small portion of Monday's gap. The near-term line did not, or got above 80 yesterday, but just barely, did not stay above 80, and is back down. It's flirting with getting below bullish territory. Of course, if we were to get in the bearish territory, again, that kind of signifies the peak here. I actually think we'll probably end up rallying the next couple of days into, towards this area here into 380 into expiration day, and then I think that's when things will probably get, obviously things were really volatile the week after October, July, April, January expirations, because that's when earnings season really kicks in gear. We're still below the moving average, of course. We've got the red line. We have light green shading because we are rising above the 20th percentile, though still easily in bearish territory, and for that matter, still below market sentiment. So if we do rally, it's not necessarily a high probability, but even if we do rally, it probably won't be too significant. Again, to get above the 30-day moving average today, it's sitting at 37.7092. We'd have to get more than 2.5% above it today. We'd have to be at 38.65, which is right there. I mean, that would be clearing all these lines. Obviously, tomorrow the line's going to be lower than it is today. And so, again, to get above 2.5%, essentially to change the trend, we're going to have to clear that major hurdle, like this really strong resistance. We already got there once. It failed. Resistance held, as you would expect, because you always expect support or resistance to hold until it doesn't. So it failed already once, and looks like it's still not even getting that close this time. Though I do think by the end of the week we'll probably end up in that direction. Of course, that sets us up for the potential for next week. Again, we've been talking about this Arun indicator here as now that the high point, the 4-week high point's right there, the closer we are to that by the end of this week, the more likely we are to get a bullish breakout. That would, in this case, start an intermediate rally to the upside. On the other hand, if we end up down here, closer to 3,600, 3,500 by the end of the week, then more than likely we're going to get a jump back up here in the momentum line, the negative indicator up to the upside. So that's the problem that we have that's the problem that we have right now going on with this current move on the S&P, is it's actually kind of in the middle. It's not really close to the 3,800. It's also not really close to 3,500 either. So we're just kind of stuck. I don't think we'll stay stuck, but if we do stay stuck, that will kind of open up the door of to some more uncertainty going into next week. We'll have a little bit more certainty in terms of the potential of a bullish run, because again, we clear 3,800, then that means we're starting. You can expect that we would get dark green shading and eventually a green line. Like, we'd be far enough above the moving average that we could get above. Again, it would have to be above 2.5%, not just at it. But we would be far enough to start pulling that line up, and we get dark green shading and green line that starts an intermediate rally. And starting an intermediate rally at this level is really important, because that would still keep the door open for just a correction. That this is just a correction, a gap fill between the 15 to 200 week moving averages, which is what a correction is, and then a bounce off the 200 week to new highs, right? Which is what a correction bounce is. I think that's a very low probability scenario. You can see we got higher lows in the MACD with a lower low here. The possibility is still there. That there is still, that door is still open. Relatively low probability, probably in the teens, 20%, but not 0%. And that probability will increase if we start the intermediate rally now, if we break above 3,800 now. I don't expect that to be the case. I expect resistance to hold, because you have to until it doesn't. Obviously, not only is at the 3,800, if you would clear that level, you would also be clearing the 17-week moving average, and then getting the MACD above, but you can see the MACD is nowhere near getting above its average. So we're still probably a couple weeks away from really having a bullish divergence going there. But you are starting to get some bullish Hakunashi candles. You can see the PPO, get rid of that line, but it's relatively low PPO. We are getting a higher close right now, so a good follow through on this next week would be strong, right? A good follow through, because again, if we're closing towards 3,500 by the end of the week, then we're going to be more likely going to have a reversal back down and back below this close of the week prior. That would be bearish. Again, we've seen this play out before. But if we were to close up here towards 3,800 and sustain that next week, then we'd have the reversal, right? We'd close above this body. We'd have the reversal, a bullish reversal like this, that we expect multiple weeks to come out of it. Multiple weeks would get us above 3,800, above the 10-week moving average with the green arrow, a rising PPO, and then again, the beginnings of a trend, of an intermediate trend. See, there's an intermediate run right there. There's an intermediate run. We would expect another intermediate run right here. Again, coming off of that 200-week moving average would still open the door for a move to the upside. Again, it's hard to come off of a lower low and get up to a higher high. So get up higher than this one that we had in August. But it's easier if you're coming off of if it was a divergent low point, which you can see, as we talked about on the MACD, this would be a divergent low point, slightly lower low with higher oscillators. This is more of a washout phase, and the higher oscillators that would lead us to a long-term move to the upside. So again, that's the possibility, and that door is still open to that possibility. However low the probability of that happening, I think the likelihood of that is low. But we have to be aware of it and know when those probabilities would start to increase. And again, it would majorly increase upon a break above 30, let's say 38.75, because that would clear the 2.5% hurdle easily. And we'd have everything else that we need here. We'd have a good bullish reversal here, and everything else would be that much more bullish, right? You'd have, some of these other oscillators. Let's go to the 3 green arrows, right? You'd have that third green arrow, because we already have 2. you'd have the third green arrow there that we're already getting on the Dow Jones. See, the Dow Jones has the green shading and the yellow line. Remember, that's it's a bearish signal at first. You get them on bearish trends as bear tag, so they're either bearish signals or they're the start of bullish runs, right? That's, they're kind of like that inflection point. You either stop here and hold and continue lower and maybe a little bit higher like you saw here, and hold and continue lower, or you start your bullish run to the upside. And the Dow's got it. And the Dow, the intermediate line has crossed above its moving average. So it's actually looking a little bit more bullish. The other indexes don't have that as much. Then the Russell did get it yesterday and already is back down today. The Russell had a bigger drop today. And you can see, after trying to get going here to the upside, breaking above the 30-day, it's already back down below the 17-day by a little bit, not by much. And it did fill in that gap there, but it has not filled in, again, the gap from Monday morning yet. Remember, when there's big gaps between the 30, the 50, and the 200, or even the 17 and the 30, then pretty much you just fill in those spaces until they get close enough that you can break them both at the same time. We're still not bullish enough that we can break both of these or multiple lines at the same time. The MACD is a lot more positive, so we're open. See, that's when you got the breakout over here, the MACD and this moving average was a lot closer to zero, very similar to now. So it's easier to get it now than it is back over here when the MACD and this moving average are both really low. And for that matter, even the stochastics was oversold. You need a period of convergence, which it appears we've been getting. And when you look at the DMI, we're not nearly as bearish, but we're still not bullish. Like, we're still well below 25 on the positive indicator. And we're still actually holding 25 for the negative indicator. The ADX has been strong and is reducing a little bit here, not surprisingly. Even the Dow Jones doesn't have that positive indicator above 25 yet. And of course, we saw the weakness in the Russell today being as strong as it was. The negative did drop below 20, but bounced right back up. The positive, again, for the second time, looks like it's held 25 so far. So you see how really important some of these levels are. S&P is at the blue line, still holding a strong trend below the cloud. The Dow Jones Industrial Average has ended its trend, and it got above the blue line. And you can see it's ended that trend there, and you see how close we are to getting a positive 26-day rate of change. That's also a precursor to a change in trend when the rate of change, so you can see it here. Again, this red line here is the 26-day rate of change. This is easy to see it visually there, but essentially that is this chart here. So when you look at the 26 days here and here, you can see you get your bullish intermediate runs when you get a positive crossover on these rate of changes. When you've been bearish, right? So you can see how you get your pullbacks when it crosses below zero, and then extended pull, when you get these big extended declines. But then you start your bullish runs when it crosses back above zero, right? So we've seen that multiple times here, and we're about 6% away from it happening right now. So that kind of gives you an idea of just how close we are. If you look at the Dow Jones, it's only 2% away. And you look at the Russell 2000. The Russell 2000, it's still about 5.75% before they cross zero, and we get that confirmation there of each of the red line dropping. Now, granted, that even if we just go flat for the next couple of days, we're going to get closer on that rate of change because the price is dropping. So again, when this line crosses above the price, that's when that rate of change crosses above zero, and it signifies one of the signals that we're starting a new intermediate leg higher. Like I said, the spiders, IWM also has not ended its trend. It's weakened, but we never did really significantly get above the blue line. We're back below it, and we still have very strong levels there. Looking at the RSI, we're still below the midpoint. We never did get above positive 100 on the S&P. The Russell did get above 100, but it's back down to the middle of the chart. So as of right now, neither one of these are showing bullish signs either. But you see where the breakouts need to occur for that to happen. S&P got up to the middle of its bandwidth, not to the upper quartile. The diamonds are also flirting more, getting closer to being in the upper quartile. IWM is actually still in the lowest half, but still kind of flirting there, not trying to figure out what it wants to do. And then the Qs are the worst, right? They're easily below. Again, no bullish trend until you're at least in that upper quartile, breaking out of these bands, especially when you have the Keltner channels, the Bollinger Bands inside the Keltner channels. You got the red dots. Then to change the trend, you need to break through that level. Your RSI, typically when you start a new bullish trend, your RSI needs to get above, get going strongly to the upside. Here, that actually ended that intermediate run. So that was a sign. Excuse me. That was a sign that was kind of a fake out type move. One of the many that we talked about then, including the on-balance volume, which again we still have now, not confirming this move that we're getting. Again, you can see compared to where we were on June 17th, we are just slightly higher, but the volume is still much, much lower, right? For SPY compared to where we were on the 17th there, we're still very much lower. So we're still not getting any bullish volume here, at least enough to either match or offset the weakness that we're getting. Even if you look at right here on 23rd, we're break even right now. Been up and been down, but we're essentially break even from where we were on September 23rd, which was about a month ago. But if you notice down here, the volume is nowhere near where we were on the 23rd. So a lot more down volume than up volume, and that's one of the signs of, that we're probably not going to start a new intermediate run, that we're more than likely going to have that leg lower. But we need to be aware, and if we do get the breakout, then we'll see if that confirms. If we do get a strong move in volume, again, normalize the price. That's what money flow looks at the volume normalized to the price of the index. But that any good strong breakout like that should be confirmed by a good amount of volume there. Speaking of volume and volume, today's volume was light at 80 million, so we're back below the average. The range was also light, 6 points, and then we filled in the gap there, so just 6 points total. So when you put those numbers in the average, 80 some odd millions down in this area, so below the average. 6 points is also below the average. Still easily above 2%, or at least close to 2% for the ATR. So not bearish enough really, but you want to get these kind of numbers that we're breaking down below these averages after we've established the new intermediate trend, not while we're trying to establish a new intermediate trend. That's again another sign. And then of course your VIX is showing a fascinating pattern, staying above 30, actually right around 31. And so you got a VIX right around 31, but your VVIX it's dropped like a rock. Your VVIX has gone all the way down to 90. The Bollinger bandwidth for volatility has also, which is kind of very similar to the VVIX, has also dropped to one of its lower levels in quite a while. You can see if I follow my cursor all along, it's relatively low. And when volatility gets this low, it typically leads to a breakout. When the bands get inside their Keltner channels, it typically leads to a breakout. And when you look at the breakouts here, the bullish breakouts, they tend to be to the upside. When volatility is low, the breakouts tend to be to the upside. And that's, we are really consolidating. Again, with the VVIX as low as it is, that's a really, really low number, for, considering how high the VIX is. Very rare for it to be below 100, much less be at 90 with the VIX itself at 31. So again, it goes to show that we might be, kind of settling in for a couple of days until expiration, but that pop might be coming post expiration. All right, now let's take a look at what's driving the price action here. You can see the 3-month chart of the major different asset classes. If I go to just today alone, you can see the biggest mover today continues to be the dollar. Commodities are still outpacing, if not rising on an absolute basis. They're still outperforming everybody else. And of course, bond yields are up too. So those are your three-headed monster that you have going on right now. If you go back to just the past few days, stocks have been relatively bullish thanks to that gap open on Monday. But you can see we're not extending those gains. They're basically just, what has been performing well has been pulling back, except for bonds. Bonds are just bearish in any environment right now. with yields rising. But the dollar, bonds, and commodities had been most bearish. Bonds continued bearish, but commodities and the dollars you saw outperformed on the day. Let's go back to, let's take a look at bonds. Let's look at TLT as a proxy for bonds here. You can see the move that it's making. It's just continually grinding lower, well below the 17-day moving average for, in fact, it's been below the 8-day moving average for many days in a row now. As the MACD is below its moving average, but not really like, there's the histogram is really small. So the histogram, if I were to, here, let me take off these lines, because the PPO will kind of throw off the scale of the chart. So let me show you the MACD here. Let me put it in a little bit of perspective, so we can see the strong trends that we're getting. So you can see, that where the biggest pushes to the downside were in bonds. So like big moves that that grind lower, and then the pullbacks have been getting bigger too. Like this one was a longer pullback because it had a bigger histogram, and you can see we were kind of setting up for that there with this big jump to the upside. You can see another one over here that led to a longer rally too. So we've been getting gradually smaller momentum moves. So that's why, again, we're probably going to start moving, getting to the point of basing here. You can see the histogram on this chart is really like we're really strong levels relative to where we've been in the past. I mean, this move here, just this move off that peak, matches some of the biggest moves that we've seen in bond prices, and just in a short amount of time, matching the big move we had at the beginning of the year. Obviously, as of right now, would be a divergent move because this is obviously a much lower low and still a higher low, and you can see that on multiple indicators, right? When you look at the weekly chart here and look at TLT, you're also setting up for the potential of a divergent low point, and slightly higher low, if not a little bit equal, with a much lower low here on this chart. And of course, when you look at like the DMI and the ADX here, again, this is a daily chart, but the ADX is about as high. I mean, this is the highest it's been in the past year. And just for some perspective, it's a relatively high level. We were this high in 21, at the beginning of 21, when the Russell 2000 went parabolic. There was a big move in the reopening trade, and bonds fell in that regard. Well, this time it's more, we're not getting necessarily the big move to the upside in stock prices, but we are getting still a continued move to the downside in bonds. You can see the positive DMI has, when we get this low, it's kind of marked lows, cluster with that arrow there, and we got that low point, a cluster with this arrow here, and after a month or so, ended up marking the bulk of the weakness. Well, again, we got multiple arrows now here, lower than any of those other levels on bonds. Even the negative ones kind of mark the tops in some of these spots. But this is a, you can see, where the bonds are starting to really go extreme, like parabolic in their extremes, to the point where, you're starting to get, some of these strong indicators to the downside, extreme, like reversal type indicators to the downside. The S&P broke into the bullish area, so broke above 60 in the upper half of the chart, above 60. It's a good sign. The average is coming up above 20. So again, a break into 80, a sustained break into 80 to get the average up. Again, it's another one of those signs. Getting above the average is a great sign to begin with, but we have to be bullish enough now to get it up because it's been so low. Again, that would require a break above these levels. So you can see a lot of these signs. TLT has been, so bearish that its average has been down for so long. Again, another one of those signs of, extreme bearishness. Unfortunately, the dollar maintains a very strong move too to the upside, as it's been trading well above its 30-day moving average, and had come down last couple of days, but got it back above its 17 and 8-day moving averages today. Commodities are also kind of flirting with kind of like trying to consolidate in this area and break back up. Again, a breakdown, which is what I think a lot of people would like to see. We've had three different correction moves, strong correction moves. Like all of these different asset classes were well above. There's a huge gap between the 50 and the 200-day moving average. Like for as long as they've been in existence, this the highest gap for TLT, and you can see the correction that it filled. For SPY, it's one of the higher gaps it's seen. Only the 90s was higher, and you can see it filled in the gap. So commodities also has the highest gap of its existence between the 50 and the 200. It's 1, 2, 3. These are the famous intermediate market relationship. Currencies first, right? And we also had, you can see the dollar had its correction move. So it actually started it coming down into between the 50 and the 200. Not as strong of a move as we saw in 2014, not as big of a gap, but still you had the correction, the bear market. Then bonds had theirs. Then stocks are in theirs right now. And then, of course, commodities. But keep in mind that commodities only falter like this when we are in a bearish market. All right, the last bearish market we were in kind of a quasi one through 18 and 19 that was masked by the strength in the mega cap name. Same thing in 15 and 16. But you can see the strong declines. Remember, they had some big impacts on international equities. There's 15 and 16, the bear market they were in. There's 18 through 20. You can see multiple touches below, well below the S&P ever did. And so, so they're kind of like, I don't think necessarily we want to see commodities filling in that gap and starting to correct, because if and when it does, then that's the start of the recession, right? Because that's what creates the lack of demand that pushes commodities down from these relatively high levels and the lack of demand that coincides with a recessionary economy. Let's take a look at how sectors here did today really quickly. We'll look at the 12 grid first. So we're getting light green shading across the board with red lines, a little bit of a yellow line there in industrials, close on communication services. Still got some dark pink shading and red lines in other consumer areas, utilities and real estate, too, interest rate sensitive areas. Of course, energy remains the one outlier to the upside, just very strongly bullish. Again, that's another sign of a very mature bull market that's ending, is when energy outpaces just everything else. Because it's the most lagging sector out of all of them. Benefits the most from inflationary levels, right? When commodity prices rise and inflation rises. Let's look at the comparison chart for just today alone. You can see energy is just killing it. Continues just to be a really strong outperformer, up nearly 3% today alone. Communication services is the only other sector that gained. Everything else was down. Discretionary was down more than the broader market, in addition to interest rate sensitive areas, healthcare and real financials maintain their position because of that yield curve that remains strongly inverted to the downside. So if we're going to be bullish, we're going to take off to the upside. It needs to be run by technology, discretionary, and communication services. Discretionary had been pretty bullish this week. Industrials is up there. Materials is up there. Those are economic growth sensitive sectors. But we don't necessarily want to see energy up here such a strong gainer. Again, not your typical bull market general, right? It's generally the highest sector weighted areas, not the smallest. And that's technology and again, discretionary and communication services. All right, that brings us to our trade idea of the day. Considering that we're almost done with this expiration cycle, and considering that it's been quite a relatively neutral expiration cycle after a really bearish one there in August, we started off pretty bearish here before this last little rally has got us off. Long lower shadows got us back up. So pretty decent size range, bigger range than what we saw last cycle. Not as big as the July to August expiration cycle, but you can see kind of the move, and we're still 6.5% below the moving average, so it hasn't been bullish enough of a move to switch it. But it's been the kind of move that has been perfect for these kind of iron condor type spreads, and that's another one. We've been doing a lot of those, and we'll do another one here tonight with Boeing. kind of moving up towards its own Fibonacci levels, sitting right at its moving average, light green shading, yellow line pattern, intermediate line flirting with breaking out of bearish territory and above its market sentiment line. You can see, not bearish anymore, but not bullish enough to be bullish. You got as of right now, this is the kind of pattern we'd like to see next week in the S&P. You got the higher close, and now we're confirming that with a higher, closing above that body. With this week's PPO turning up higher is a good sign as well. From a 3 green arrow standpoint, Boeing has 3 green arrows now. That's what happens when you get light green shading, yellow line. Typically, you also get 3 green arrows. But you also see that we are sitting right near the point of control. We're sitting at the 30-day. We're not really breaking out here. The MACD and SOCAT, the MACD, both the 8 and 17-day haven't crossed. There's still a pretty decent space between the 30 and the 50. So it doesn't look like a breakout type pattern, but it also doesn't look bearish anymore either, especially now that we're back above the point of control. When you look at like the RSI and the CCI, sorry, wrong chart. Here we go. Relatively neutral positions, a little bit bullish on the CCI, but on the RSI, a neutral position, really neutral on the DMI, both lines between 20 and 25. So the ADX is dropping like a rock. And then, of course, no trend going on right now. What bearish trend it had has been broken, so you don't have any kind of trend going at all, even if you are a little bit below the cloud there. So relatively neutral patterns. You can see from the Bollinger bandwidth that's been falling. It's getting relatively low. We are towards the middle of the bandwidth. So again, the perfect type of setup for what we've been doing a lot of lately, and that's iron condor type spread. So if I were to look at Boeing here, move it down here, you can see I've sold the 125 at the low 20 delta, sell the 155 also at the low 20 delta, buy one strike away, which happens to be $5 away in both of them. That sets you up. Again, we do have earnings coming up, so the nice thing about earnings is you get enough premium to get a normal reward for far less risk than normal. So instead of going for the full $1,000 of risk, I'm only going for 2/3. Again, that kind of sets you up, right? So, if I did 5 different trades like this, then I can get 5 times the normal reward versus only 3 times the normal reward normally when I put $1,000 at risk on each trade. So it kind of gives you an idea. It helps get a little bit more reward for the volatility, but also spreads out my risk across more trades. As you expect one of these, most of them will probably stay in the range, hence the probabilities, but 1 or 2 of them might break out one way or the other, especially depending upon the pattern. But a lot of the patterns we've been looking at have been pretty neutral like this. So they're set up for positions that are going to be converging more and more, neutralizing themselves more and more. You can see the MACD is turning up, not quite above its moving average, but it's starting to turn up. We're still below the 17 days, so we're starting to converge a little bit, and that's perfect for iron condor spread opportunities. Okay, well that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com like I showed you earlier for free. Click that like on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.